Hey, who ordered the bad news buffet? We've got a lingering pandemic, a war in Europe. We've got rate hikes, sky-high inflation. Does the classic 60-40 portfolio still work? Let's ask the CIO of Cambria Funds, Meb Faber. Meb, first of all, the stock market, S&P 500 down, all the indexes down double-digit percentages this year. Further to fall?
I hate to be the bearer of bad news. Come on, man, it's the weekend. But I think the answer is probably yes. And for the last couple of years, look, there have been a lot of yellow flashing lights. You had valuation. Stocks got really expensive last year. 10-year P ratio hit almost 40. We're down some now to the mid-30s. You had all the craziness going on with IPOs, SPACs, yield curve inverting, inflation going up. And this year, of course, you have a war to boot. But the challenge is if you look at U.S. stocks, they're still expensive, particularly in an era of high inflation, 8% now. There's a scenario where if you look at historically speaking, the multiples people are willing to pay for high inflation type of environment is about half of where we are today. So it doesn't mean it has to happen, doesn't mean it's going to crash. It just means that historically speaking, stocks are really vulnerable. Add on with it, they're in a downtrend today, which historically has been a really dark, scary place. Expensive stocks in a downtrend.
I liked everything except the part. I liked everything except the parts about half dark and scary. So what should I do? I'm a buy and hold guy only because I'm pretty sure I'm the worst market timer in America. So am I doing something wrong? Is there something more tactical that I should be doing in this market?
Part of it is just education and history, right? Like we all understand, you look back far enough, bear markets are normal. Stocks go down 50%. Even in the Great Depression, we had a time when they went down over 80%. And that's a feature, not a bug, right? That's part of the entry cost it takes to be a stock market investor and get the gain. So buy and hold, we manage a buy and hold ETF. We think it's fantastic. But the problem in buy and hold is the hold. And for a lot of people, that's really tough. You know, sitting through the downdrafts, having that iron, steel, emotional fortitude, because it all happens at the same time. Usually the buy and hold hits the fan when you have a recession going on, and often bonds help. This year they're not. If we close today, this is would be one of the top 5 worst years ever for 60-40. And even 60-40 back in the day had a 60% drawdown, right? So it can get worse. So stocks and bonds, while sometimes they zig and zag, they don't always. We think one of the best possible things you could add to a traditional buy and hold portfolio is an old strategy called trend following, and it's one that diversifies, but it's also not easy to follow.
Well, I'm going to try to keep the iron and the steel and not the hitting the fan part. But let me ask you about one of these kind of buy and hold funds that you have. It's called Cambria Shareholder Yield. It's both dividends and buybacks that the fund focuses on. It's beating the market this year. Dividend stocks are doing great. Is it still time to buy a dividend fund like this?
If you look at what this strategy is, and it's a very basic value Buffett-esque style strategy, big cash flows, trying to buy them cheap, and making sure the companies and the CEOs behave by returning that cash to shareholders, agnostic through dividends or buybacks or both. Net buybacks, that's important. Historically been a fantastic way to invest. And this fund's done great, like you mentioned, particularly in the last couple years as you have this value trade coming back into fashion. For a long time, it was just the romping, stomping growth stocks, but now you have a little more sobriety coming to markets, but that spread is still at some of the widest we've ever seen, despite the big move in value stocks. So we think the value stocks can go up and the expensive come down, or both.
Here's another fund of yours I think is beating the market by even more. Cambria Value and Momentum. The ticker there is VAMO, V-A-M-O. What in the heck is value and momentum? I thought that momentum was all the expensive stuff and value was all the stuff that's cheap, but you're embarrassed to tell your friends about it. How do you get momentum and value at the same time?
I mean, usually there's sort of a yin and yang idea. Value, you're buying what's cheap. Momentum, you're buying what's going up or has gone up. Sometimes they overlap, sometimes they don't. My favorite investment is when you have a cheap stock or security that's also going up or going into an uptrend. Now, this strategy, by the way, we wrote a piece about a year or two ago called Totally Not Crushing It, because this strategy was terrible for like 5 years. And then something changed. Regime changed 2020, 2021, all of a sudden value is coming back. And so you have these cheap stocks that are going up. We were buying energy stocks. Nobody wanted those. Look where we are this year. This fund has one additional feature that's pretty cool. It'll hedge with futures the total market exposure based on what we think the broad market, if it's expensive or in a downtrend. So this fund currently is actually 100% hedged against the S&P. So people would call that market neutral. So we're trying to buy the good stuff, but hedge the broad market moves in case you have further decline. So right now we like the way it's positioned.
I'm going to keep an eye on it. Meb Faber, thank you.
It's great to be here.